So picture this. You wake up on January 30th, 2026, and you check the markets. And what you see is a complete and utter financial bloodbath. If you were an investor in precious metals, that's exactly what happened. A market that had been on an absolutely historic tear, suddenly, violently, just slammed into reverse. We're going to break down the wild story behind what people are now calling the Great Precious Metals Crash.
Just look at this number, negative 31%. On that one single day, silver had the worst trading session in its entire history. It plummeted by almost a third of its value. I mean, it was a drop so shocking it left market veterans completely stunned, and a lot of smaller investors, well, they were totally wiped out.
So the big question on everyone's mind was, what on earth just happened, right? Was this just a natural correction after a massive run-up, or was there something else going on behind the scenes? In this explainer, we're going to piece together all the clues and try to figure it out. Okay, to really understand the crash, you first have to understand the setup. Because before the big fall, precious metals weren't just doing well. They were on an absolute tear. The whole thing was being fueled by this widespread economic uncertainty and a US dollar that just kept getting weaker.
This chart, wow, it really puts that rally into perspective. In just the first month of 2026 alone, gold was already up 22%. And silver, it had rocketed an unbelievable 62%. I mean, in market terms, the prices had gone completely parabolic, just straight up.
But as we all know, every fire needs a spark. And for this market inferno, that spark came from a huge political announcement straight out of the White House.
On Friday, January 30th, President Trump named his pick to lead the nation's central bank, the Federal Reserve. His choice? Kevin Warsh, a former governor of the Fed. And this single announcement, well, it was the catalyst that changed absolutely everything in just a matter of hours.
So you might be wondering, why did this one name matter so much? Well, as this quote from Al Jazeera explains, Wall Street saw Warsh as a conventional, pretty moderate choice. See, the big fear was that Trump would pick an ally who'd just slash interest rates to juice the economy, and lower rates usually mean a weaker dollar, which would have pushed gold and silver even higher. Warsh was seen as the opposite, someone who would actually fight inflation, which usually means keeping rates steady or even raising them.
And that single announcement set off a clear chain reaction, like dominoes just toppling over. First, the market felt this big sense of relief and stability. That relief immediately strengthened the US dollar. And a stronger dollar, well, that was the perfect excuse for traders to start taking their profits after that massive run-up in gold and silver. That's what triggered the huge wave of selling.
But here's the really crucial point. The nomination was just the trigger. A simple correction is one thing, but this was a full-blown crash. It turns out there were several hidden factors just brewing under the surface that turned a wave of selling into an absolute tsunami. According to analysts, there were 4 key technical factors that really amplified the crash. You had investors in these really extreme positions, a lot of them were using high leverage, crucial market safety nets completely failed, and some actions in the Chinese markets just added fuel to the fire. We're going to focus on 2 of the most critical ones, leverage and the failure of those safety nets.
Let's talk about leverage for a second, because this is super important. Think of it like using a tiny lever to move a giant rock. It lets you control a huge investment with very little of your own money. Now, that is fantastic when prices are going up, but when they reverse, your losses get magnified just as dramatically. And the silver market, it turns out, was absolutely full of it. And what made everything worse was a mechanical failure. You see, markets have these things called circuit breakers. They're like automatic switches that halt all trading during a massive plunge to give everyone a chance to just breathe. Well, on this particular day, for some technical reasons, those circuit breakers on the main commodities exchange, they never triggered. That allowed the downward spiral to just keep going, completely unchecked.
Now, that's the conventional story you'll hear, but there is another, much more provocative theory out there that suggests this wasn't just some perfect storm. It might have been a deliberately engineered event.
So you've really got 2 competing views here. On one side, you have the natural correction theory. The idea is simple. Prices were just too high, way overvalued, and the market was due for a big fall. But on the other side, you have the deliberate takedown theory. This one argues that large institutions actually orchestrated the crash to benefit themselves, all at the expense of smaller traders.
And the people who believe in this takedown theory, they point to a few, let's call them suspicious coincidences. First, in the days right before the crash,
The main exchange kept raising margin requirements. That basically means asking for more cash up front, which really squeezed the smaller traders. Then, reports started surfacing that JP Morgan, a huge player that had been betting against silver, closed out its bets right at the bottom, locking in massive profits. And to top it all off, key trading systems at other major exchanges just so happened to have glitches during all the chaos.
Now, a key part of this whole argument is understanding that there's a difference between two markets. The crash we're talking about, it all happened in the paper market. You know, the world of digital contracts and funds that trade on screens. But if you looked at the physical market, where people are buying actual tangible bars and coins, the story was completely different. Demand there didn't just hold up, it stayed incredibly strong. And here is the proof of that massive disconnect. In Shanghai, traders were reportedly paying a $40 premium for physical silver over the crashed paper price. Think about that. It suggests that the real-world demand for the actual metal was completely detached from the panic that was happening in the financial markets.
But the story doesn't end with the crash. Oh no. What happened next was just as dramatic, and it tells us a lot about the true state of the market. So let's take a look at the aftermath.
Just look at this wild V-shaped recovery. After that historic 31% crash, silver came roaring back, rebounding about 25% from its lows in just a few trading days. It was an incredibly violent swing in both directions. So, what drove this powerful comeback? Well, it was a mix of things, really. You had bargain hunters, what they call dip buyers, who rushed in to scoop up metals at those cheaper prices. The dollar started to weaken again, and then some new geopolitical tensions flared up after the U.S. Navy shot down an Iranian drone, which renewed demand for those safe haven assets. And here's the crucial takeaway from all this. Despite the absolutely insane volatility, the fundamental long-term story for precious metals, it didn't really change. There is still not enough new silver being mined to meet demand, and central banks all around the world are still buying up gold like there's no tomorrow. All of this leaves us with one final and pretty thought-provoking question. This whole event, the insane crash and the wild rebound, it exposed a huge disconnect between the price you see on a screen and the real-world demand for the actual thing. It really forces us to ask, in a financial system that's built on soaring debt and digital currency, what is the true value of these ancient metals? That right there is the mystery that remains.